So I know you're of the mindset that the conflict over in Russia and Ukraine isn't going to have a giant impact on the market, but it is having a big impact on oil and the oil market. How do the two combine, impact our outlook for today?
Yeah, certainly oil over this price is not sustainable and it's terrible for our economy. It's good for U.S. oil producers, and we like the E&P space and we're overweight energy. But there's no doubt that commodity prices in this high elevated range and staying in this high elevated range over $100 a barrel is horrible for the economy. It's going to put a little gasoline on the fire, terrible pun, on our inflation situation we have right now. And we just have to be careful about what the effect is on the consumer. Strong consumer right now has led the way for the economy and given us a hope that we can avoid a recession. Cannot be agnostic to 1991 or the 2008 drag that oil prices hitting the 120s had on the economy.
So I know you're of the mindset that oil markets are hot and they're going to probably continue to be hot for the rest of the first half of the year, and you also have some stock picks. If you're looking at stocks that can, I guess, take advantage of this situation, what are your picks, and is there a best in class?
Certainly. We like Devon. Devon's our best-in-class pick. We like the Permian oil plays, the E&Ps there, Devon, EOG, Diamondback, even Pioneer. We like people that have low break-evens, great acreage. We do think there's going to be a shifting of how the world does supply and demand for oil. Right now, you may see Venezuela coming back online, which shocked all of us that the U.S. government is talking to Venezuela. But remember, we import and export crude. There's this delicate balance. So as this world shifts, we're going to maybe see more crude from Russia go to China and India, and we maybe retain more U.S. American drilled crude. However, you got the sweet sour balance and what refiners can do, but we really like the U.S. E&P space, and we think it's a good place to shelter as commodity prices spike.
You know, for a lot of the pandemic, we saw a big boom for high growth tech stocks, especially. Where do you see the opportunities at now? Is it value? Is it growth? And what factors make a good stock either way?
We like value right now. We think the growth stocks, some of them were priced to perfection, very difficult for them in a rising rate environment, and they just can't afford to miss. You can't be agnostic also. The Russian sanctions are probably going to stick around for a while, and you've seen multiple companies completely pull out of there. You know, McDonald's, Pepsi, everybody stopping selling their products, Samsung, Amazon. Those are going to drag. So if you have a high multiple stock and now you're looking at some sort of EPS drag, even if it's only 1 or 2% of sales, I think some of those stocks are going to see difficult earnings season. So we like the value stocks, we like the cyclicals, and we think U.S. large cap value is a very good place for advisors to kind of bunker in. Tend to have better cash flows, higher quality. And during times of stress, you want people that can absorb the stress, use their balance sheet if they have to, have access to financing, and generally aren't priced in a way that if they have some sort of slowdown, that they're going to take a major stock hit.
All right, we got to get out of here in just a second, Vicki, but I want to ask you, you're saying it's all about the value trade right now, but are we talking big cap value, small cap value? Is there a difference right now?
We still like the large caps. Small caps do have attractive valuation, and we're looking at them as a smaller allocation. But generally, during times of stress, big old ugly, great place to be.